Hello and welcome to our discussion on business combination and consolidation. In this session we'll see an example where we'll have goodwill, and we know that goodwill is the excess of money paid or excess of purchase consideration over the equity acquired. In the previous discussion we saw this problem where there was no goodwill, because the purchase consideration is equal to the equity acquired, because the purchase consideration has been calculated or the company has taken over the asset shares at the book value per share. Whereas in this case, you see this, we are taking A is acquiring 70% of the shares of B at the market price of the share of 80. So therefore, once again we'll calculate purchase consideration, goodwill, minority interest, and the way the purchase consideration has been discharged. The total equity of B is 100 plus 500, because the assets value is not given. A share in that is 70%, so into 0.70, and the balance is the minority interest. So that's an important input for our consolidated balance sheet. If this is A's share, and for this share A is buying at the market value per share, so total number of shares of B is by 10, and the shares acquired is 70%, 7, and the market price of the share is 80. So purchase consideration is 7 into 560. This is the purchase consideration, because purchase consideration here calculated on the basis of the market price of share, which is 80. And this purchase consideration will be used to calculate the goodwill. So let me first do that. To calculate goodwill, so purchase consideration is 560 and equity acquired is 420. So goodwill is 560 minus 420 is a goodwill. So goodwill is another additional information which is required for preparing the consolidated balance sheet. And this purchase consideration, as mentioned here, is being discharged by issue of shares at 100. So purchase consideration, you see the face value of the share is 10, but they are issued at 100. So therefore face value is 10 and the premium is 90. So the share price is 100. So the number of shares to be issued by A will be 560 divided by 100, 5.6 million share. So 5.6 number of shares into the face value, and the balance is a premium, 5.6 into 90. So that comes to 560. So we have all information required to prepare standalone and consolidated balance sheet. So the standalone balance sheet of A will have the capital 500 plus the capital issued, reserves no change in that, and a share premium of 504, no change in the long-term debts, no change in the current liability, but there will be a minority interest of 180. Minority interest of 180. Okay, and the fixed assets will be 700. The investments will be shown at the purchase price, that is purchase consideration, and the current assets is 400. No change in the current assets because the purchase consideration not discharged through cash, and there's a goodwill of 140 goodwill will be 140. So the total is we have to check why the total is not balancing. 1800 and this is 1840. We'll check once again. So the capital will increase by, let me take the formula out here. So the capital will increase by 556. Okay, we are not preparing the consolidated balance sheet, so no goodwill required, no minority interest required. I'm sorry for that. So the standalone balance sheet will just show the investments and the capital. So investments will appear in as the money you paid, and the capital will change depending on the purchase consideration discharge, which is the through capital issue of shares at a premium. So be careful about it. In a standalone balance sheet, don't show the minority interest and goodwill, because in the standalone balance sheet you will show the investments. Whereas in a consolidated balance sheet, the minority interest and goodwill will appear, because the investments will not appear, and that is substituted by the assets and liabilities of the buyer, of the seller and the buyer. So consolidated balance sheet will show the assets of A plus the assets of B and the capital of A alone. Okay, so no change in this. Now the long-term debts of A plus the long-term debts of B, the current liabilities of A plus the current liabilities of B. Here of course you have to show the minority interest. The fixed assets in the consolidated will be fixed assets of A plus fixed assets of B. Investments will not be shown. Current assets of A plus current asset of B, and there is a goodwill, so goodwill will appear. So your balance sheet is ready. So unlike the standalone balance sheet, the consolidated balance sheet, to recap, will not show the investments, but the investments are reflected by the assets and the liabilities. Any excess paid will be shown as a goodwill. Why is minority interest shown? Because while preparing the consolidated balance sheet, since you're showing the all assets of B and all liabilities of B at 100%, you are required to balance that to show the minority interest. For example, if we make a proportionate consolidation, okay, all other things remaining same, proportionate consolidation, which is discouraged, so my capital will remain same, reserves will remain same, premium will remain same, but the assets will be this plus 0.70 of 0.70 of 200, okay, 200. The same is the case with the current liabilities. The same is the case with current liability. The same is the case with the fixed assets. No investments will appear. The same is the case with the current assets, and the goodwill will appear at the total, and you see the total of assets. In this case, we are not showing the minority interest. We are not showing the minority interest because it is not required, and it is not required because you are making a proportionate consolidation. What is proportionate consolidation? The proportionate consolidation will show not 100% assets or 100% liabilities of B, but it is a proportionate assets of be added to the total assets and liabilities of A. So that is why you don't see the minority interest here. Whereas minority interest appears in this consolidated because we are making 100% consolidation. Okay, so preferably it is always accounting standard recommends the consolidated balance sheet using the 100% consolidation. So I'll say full consolidation. Okay, full consolidation, that's better, full consolidation, whereas the other one is a proportionate consolidation. Thank you very much.